The XRP ledger has been settling payments in 3 to 5 seconds since 2012. Stellar has been doing something similar since 2014. Dollar stablecoins now move billions around the clock. By any technical measure, the problem of moving value across a border was solved more than a decade ago. And yet, the World Bank publishes what it actually costs to send $200 home, quarter by quarter, across 367 country corridors. The most recent figure they have published is 6.36%. And I want to be straight with you about that number, because the date on it matters. It comes from their third quarter 2025 report. That is the newest one they have released. There is no fourth quarter, no 2026 update. So the sharpest scoreboard this industry has is running about a year behind. Sit with that for a second, because it is not a footnote. The cost of sending money home is a United Nations development target, and the best public measurement of it updates slower than a phone release. The slowness of the scoreboard is part of the story. So either the technology didn't do what we think it did, or the fee was never where we thought it was. This video argues it's the second one, and the whole explanation fits in one sentence. The middle got cheap and the edges didn't. Everything here comes from the World Bank, the Bank for International Settlements, and the United Nations' own target, not from a crypto channel's imagination. Picture the journey in 3 parts. There's the on-ramp, where your local currency becomes something that can travel. There's the middle, where the value actually crosses. And there's the off-ramp, where it becomes spendable money in someone else's hand. Crypto attacked the middle. It won. On the XRP ledger, the middle costs a fraction of a cent and takes seconds. On a stablecoin rail, the middle costs a few cents and runs at 3 in the morning on a Sunday. Now look at the two ends. Somebody has to take cash or a bank debit and give you the traveling asset. Somebody on the other side has to take the traveling asset and hand over local currency, often physical cash, often in a town with one agent. Those two businesses have staff, licenses, float, and risk. They charge for that. Here's the uncomfortable arithmetic. And I'm using round numbers to show you the shape of the problem, not to quote a measurement. If the middle drops from 3% to 0, and the two edges cost 3% between them, the total goes from 6 to 3. Real improvement, and still nowhere near free. You cannot delete a toll booth by making the road faster. The off-ramp is the part that never shows up in a white paper, because it isn't a technology problem. It's a payroll problem. Somebody has to be open. Somebody has to hold local cash. Somebody has to be within traveling distance of the person receiving the money. In dense, wealthy corridors, that person is competing with 5 others, and the margin gets squeezed. In a thin corridor, low volume, few providers, maybe one agent in town, there's no competition to squeeze it. That's why the global average hides an enormous spread. The average is one number. The corridor you're actually sending to is the only one that matters to you. The United Nations set a target of less than 3%, and the elimination of every corridor above 5% by 2030. Read that second half again. The target exists because specific corridors are far worse than the average, and they're the ones carrying money to the people who need it most. No consensus algorithm fixes the fact that somebody has to be standing in a shop with cash. Now the part that quietly does the most damage. When a service advertises a low fee or no fee, check the exchange rate they're giving you. The wholesale rate 2 banks trade at, and the retail rate you're offered are not the same number. The gap is called the spread, and it's revenue. This is why the World Bank measures total cost, the advertised fee plus the exchange rate margin. If they only counted the visible fee, the scoreboard would be fiction. And here's how it connects back to crypto. A bridge asset trade has a spread too. Your dollars buy the asset at one price. On the other side, it sells for local currency at another. If the market for that pair is thin, the spread widens, and the saving you made in the middle gets handed back at the edges. A deep, liquid market is not a nice-to-have in this design. It is the design. Every provider moving money across a border screens transactions and holds licenses in each jurisdiction it touches. That is not optional, and it should not be. It's the same machinery that stops the traffic nobody wants. But notice its shape. Much of that cost is per transaction and roughly fixed. The same screening runs on a $200 transfer as on a $20,000 one. A fixed cost is a rounding error on a large transfer and a brutal percentage on a small one, which is exactly backwards from who needs the money most. That single structural fact explains more about the 6% than any argument about blockchains. And it's why the Bank for International Settlements treats cross-border friction as a set of interacting problems rather than one slow pipe. Time for the part this channel doesn't skip. What crypto genuinely fixed: the pre-funded money. In the old model, value only moves where someone parked cash in advance. Capital sitting idle in a foreign account, earning nothing, waiting for customers who might not come. A bridge asset removes that. It also removes business hours. Ledgers don't observe weekends or holidays. Those are real structural wins, and they are not small. What crypto did not fix: the on-ramp. The off-ramp: the exchange rate spread on a thin pair. The compliance cost per transaction. The fact that someone in a small town has to physically hand over cash. So when you see a chart showing a transfer costing a fraction of a cent, that number is true, and it is measuring the middle. It is not measuring what leaves your account and what arrives in theirs. The honest claim is narrower than the hype and more interesting than the cynicism. The plumbing in the middle is genuinely solved. The economics at the edges are not, and they are where your 6% went. 3 numbers worth more than any price chart. 1. Your corridor, not the average. The World Bank's remittance prices worldwide site is free and quarterly, and it breaks out the specific route you send along. 2. The spread, not the fee. Compare the rate you're offered against the mid-market rate on the same day. That difference is the real price. 3. Corridors above 5%. The United Nations target says eliminate them by 2030. Watching that count fall tells you more about progress than any announcement. When those move, the system is actually changing. When they don't, a faster rail hasn't reached the people paying the toll. That's the honest answer to why sending money still costs about 6%. It isn't the speed, and it never was. One honest crypto explainer a day, and a long-form deep dive every Wednesday. Follow, and tomorrow we're back on the daily. Education only, never financial advice.